Sajjid Chinoy joins us to talk the economy, the market positioning, and if indeed there is a re-rating moment for India if India too comes to power. Sajjid, good morning. Thank you for joining us. Well, markets are mighty excited. Rupee has strengthened. Bonds have come off. All of them are pointing to the fact that financial markets are mighty excited with a prospects of India too coming to power. Is the market reaction in equity, bond, and currency market, is that justified?
Well, hard to say whether it's justified. I think the real question is whoever the next government is, over the next 3 or 4 months, there's a lot of nuts and bolts that need to be fixed to stabilize both growth and macroeconomic stability. We're in the midst of a growth slowdown. I think we shouldn't panic, because some of that slowdown I think is transitory. It's related to election uncertainty, to very tight government spending in the month of March to meet its fiscal deficit target, and to idiosyncratic factors like the migration to emission norms in the auto sector. But even adjusting for those factors, it's undoubtedly the case, I think, that consumption growth has slowed both rurally, in the rural and urban areas. And so I think the next government in the first 3 months will have to focus on at least 3 things. One is stabilizing the shadow banking system, the NBFC sector. And here I would argue that while some of it may be a liquidity issue, some of it may well be a solvency issue. And therefore one needs to be artful in trying to address both simultaneously, because otherwise, if we just infuse more liquidity, I'm not sure it will go to the segments that we think it will. So some kind of asset quality review at the appropriate time, of course, will need to be thought of. Now, the good news is that one can afford to do that a little bit because banks are better capitalized and bank credit growth has been picking up. I think the other area of focus has to be GST collections, because we've seen again last year the GST revenues have struggled to meet budget targets, and we can't go on year after year where GST compliance is so weak that you see large expenditure cuts later in the year to meet your fiscal deficit targets. So I would argue markets will be excited about the reform agenda over the next 5 years. But before we get that, I think we need to fix the nuts and bolts, focus on the NBFC sector, focus on improving GST compliance, having a credible budget in July. I think all of this will be required to stabilize the economy, and also will at the margin significantly help with the monetary transmission of any interest rate cuts from the RBI.
Sajjid, before we fast forward, I want to rewind. May 2014, when India 1 came to power, the problems were pretty much same. Slowdown in the consumer space, not acute, but there was a slowdown. There was lack of any fresh capital formation from the private sector. We were having global growth challenges. Today, if we stand at May 2019, the 3 challenges which were there, one was global and 2 were local. We pretty much are jumping in the same place. So what should be the way out?
No, I think significant progress has been made in the last 5 years. If you go back to 2014, what was really festering was the NPA problem in the banking system, and so that was the elephant in the room. We didn't have an effective resolution mechanism. There wasn't an effective recognition mechanism. There was clearly a worry that banks had not been recapitalized. So I think a large degree of progress has been made on that front. We've recognized the NPAs. The NCLT process has found an effective resolution mechanism, and banks have been recapitalized. I think the lessons from that have to be brought to the NBFC sector as well. And the lesson is one has to take a little bit of pain up front, but now the results are for all to see that the banking system is clearly in a better place, and you've seen credit growth, albeit of low base, picking up quite smartly. So I think that has been achieved. We've moved to a GST system again, which will have, I believe, in the coming years a transformative effect on productivity growth in the economy. But again, we need to fix the nuts and bolts, simplify the system, make it easier to comply so revenues pick up. So I would argue that we should overreact to what's happening in the near-term growth cycle. Yes, we are going through a consumption slowdown, but part of that is because we've only been relying on one engine of growth, which is consumption. So if there's one overarching focus that must drive policy in the next 5 years. It must be, what does one need to do to jumpstart or to induce private capital formation? Because as we've learned over the years, we cannot be flying only on one engine.
Absolutely echoing what a lot of market men as well have been saying. The overall private capex really needs a lot of attention. Sajjid, would also like to, just get in your views on the overall jobs, because there have been leaked statistics apparently that talk about the unemployment rate at a 45-year high, and that is an alarming number. A lot needs to be done to, productively employ those 1 million people entering the workforce each month. What do you think has been the approach to employment so far, and what do you think is the way ahead?
It's very clear now that over the last 30 years, in a labor-abundant economy such as India, unfortunately, our production techniques have been becoming more and more capital intensive. There's a lot of research now that shows that in organized manufacturing, labor intensity in India has fallen by a factor of 5. And you can see this also in our export basket. 15 years ago, 50-60% of our exports were labor intensive: textiles, leather, gems and jewelry. Fast forward to now, and 60-70% are highly capital intensive: engineering goods, pharmaceuticals, auto parts. And part of this is not surprising. It's a global phenomenon because the relative cost of capital has come down all over the world because of technological progress. The relative cost of machinery and equipment is down compared to labor. In India's case, what's exacerbating the problem is that the relative cost of labor remains very high. Not the absolute cost, the relative cost, because once you look at the challenges related to skilling, education, the frictions generated by stringent labor laws, the productivity adjusted cost of labor is very high. So this is a grave challenge that policymakers have to face, that if this mix of labor and capital doesn't change, India could well have 7 or 8% growth for the next 5 or 10 years, but we won't be creating the commensurate number of jobs. So we've written, in fact, that once you stabilize the economy in the near term, focus on the NBFC sector, the budget and the GST, the policy focus in the next 5 years has to be twofold. What does one need to do to induce private investment, number one, and number two, that investment growth itself will not be enough to create jobs. How do you make labor a more attractive factor of production? And that will require education reform, health, skilling, and certainly revisiting labor laws.
When we say that we need to get the private sector investment going in, it's like saying that we need to eat healthy food and avoid junk. We all know that. I think the government also knows that. But the challenge is that there is no mechanism which has been able to fix this problem. Time and again, the government has attempted it. Time and again, we've had issues which crop up either from the global markets or from the local markets. So whereas the attempt is there and a realistic hard attempt is there, do you think for the private sector capex to pick up in a meaningful manner before it starts contributing to India's GDP and capital formation, we are at least 2 years away?
Well, I think there are some subtle but important differences compared to 3 years ago. Number one, if you look below all the gloom and doom about growth, what you will see is in the manufacturing sector, capacity utilization is at a 6-year high. And part of it is because corporates haven't invested for a long time. But the fact is, we're now getting at 75, 76, 77%, and you're slowly getting to the threshold which will induce corporates to invest again. So once we stabilize demand and hopefully consumption in the coming quarters, I would argue 4 to 6 quarters from now, utilization rates will be at the level at which you should get more investment. Now, what are the risks that will come in the way? For me, anybody that argues for more fiscal stimulus, my prescription is exactly the opposite. Right now, the yield curve is incredibly steep. I mean, the overnight rate's at 6%, markets expect some more monetary easing, and yet the 10-year bond has been stubbornly around 7.5%. If the fiscal does not retreat and the yield curve remains that steep, that is going to be a big headwind for private investment, because ultimately domestic financial savings in India are between 8 to 10%. India's public sector borrowing requirement, central government, state government, PSUs, is running close to 9% of GDP. So there is no financial space here that the private sector can use. Therefore, what's very important in the next coming years is, as utilization levels pick up and the private sector gets more inclined to invest, the government has to retreat, right, and create that financial space. Interest rates will soften and that will crowd in investment. If we don't get that, my fear is one of two things. At the first hint of private investment picking up, you would see long end interest rates be bid up, and that will result in some crowding out, or domestic private investment will be financed by foreign savings, and that creates its own vulnerabilities down the line. So for me, I think there is some hope on investment going forward. Apart from the implementation bottlenecks, which we've talked about forever, the power sector land, what we need to do is the public sector needs to gradually withdraw, push interest rates down at the long end, and that will help in any private sector capex cycle starting again.
I mean, interest rates remains low, return proposition for an entrepreneur or someone who's betting his capital increases. Okay, Sajjid, I'm just going to take a slight detour and talk about NBFCs. It's anyone's guess as to, what is the inside story and what kind of liquidity crunch some of the NBFCs have. But if you have to take an outsider view, do you think somewhere the asset liability challenge which had grappled the entire NBFC space, that is behind us, and gradually and slowly now we are in that healing process?
I think that is the sense here, that things are gradually getting better, and I think the RBI is working hard to ensure that the ALM mismatches are less. But I would still argue financial conditions are tight in the NBFC sector, because in my view, this is not just about liquidity anymore, right? There is clearly a solvency problem on some balance sheets, and this is the classical, asymmetric information problem where markets, whether it's mutual funds or banks, don't quite know the good apples from the bad apples, and therefore you're not lending or not inclined to lend to any apple, right? And so this, in my view, results in allocative inefficiency, because even those NBFCs who may be solvent but are illiquid may not be able to attract money. There is this trust deficit, so to speak, which is why I'm of the view that while some liquidity provision might be important to ensure that a liquidity problem doesn't become a solvency problem, it will by itself not fundamentally solve a solvency problem. And what we've learned from the banking sector over the last 5 years is, the more you push the can down the road, the greater is the foregone growth and the bigger the problem becomes. So I would argue, at the appropriate time, not when it would create panic, some kind of AQR, asset quality review, will be needed. I think when the regulator is able to do that, that will calm a lot of nerves in the market, and once the umpire is able to attest that most of these firms are solvent, you will see financial conditions ease. So I think we need to approach this not in a piecemeal manner to paper over the cracks, but over the next 6 months in a more holistic manner, where liquidity is infused, but we do an AQR, and certainly we want better recognition, more capital adequacy, and better regulation down the line.
Thanks very much then, Sajjid, for joining in and really putting into perspective all that really needs to be looked at with a magnifying glass when it comes to the macro picture, all that has been done, as well as the road ahead. That's the take coming in from Sajjid Chinoy.